They're out of money. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, McDonald's just dropped a bombshell warning, and this goes against everything the government is telling us about the economy, because the government is telling us that the U.S. consumer is getting ahead of inflation and has money to spend. But what McDonald's is telling us is that consumers can't even afford a value meal. And why this is so frightening? Well, it means simply we're on the edge of a recession. But that's not the only issue facing McDonald's. They're about to ban cash altogether. I'll show you why they're doing it and why this is bad news for the U.S. labor market. Now let's head over to Bloomberg, where we picked today's story up with a headline: as McDonald's extends the $5 meal and battle for cash-strapped consumers. And this, if you think back to when this was announced, when McDonald's said, look, on a limited basis for a limited time, we're going to put out some $5 value meals because we know consumers are hurt, but we believe in the soft landing. We believe in the Fed and the power to turn the economy around. And McDonald's said this would be a limited time offer. A lot of the store owners backed up and said, hey, wait a minute, we can't make money at this. McDonald's said, don't worry. Now they're looking at extending this. It all has to do with the fact that we're not seeing the soft landing, that consumers are financially strapped, and as you're about to see, running out of money. The chain will extend the $5 meal deal that debuted in June into December in most U.S. markets. The move points to how much fast food chains are competing for budget-conscious guests. McDonald's has also been looking to challenge the perception that its prices have gotten too high after competitors introduced value meals months before it did. We're committed to keeping our prices as affordable as possible because this is just an indication. It's not just the fact that people that eat at McDonald's are budget conscious. What it means is people do not have the discretionary money to spend on something as simple as going to a fast food restaurant. And that's one of the first signs we see of an economy that's slowing down, where there's just not enough money, where consumers shift their spending habits to staples instead of discretionary. McDonald's here being a leader in the discretionary space, again, indicating that we're seeing household budgets strained and consumers not even being able to really afford a $5 dinner. And there's evidence that what's going on at McDonald's is broad-based as we look at the consumer price index. So I want you to see the government data, why they believe that a soft landing here is achievable and that perhaps if maybe a couple Fed rate cuts will do the magic. Because when we look at the CPI in blue against total compensation growth, this shown as average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. Now that's in red, and they're both on a year-over-year rate of change. What you can see very clearly here is total compensation growth is holding up against declining inflation. And when we see that, what it tells us is inflation's about to turn around and head higher, as we see here heading into the dot-com bubble and the global financial crisis. So everything points from a data perspective that consumers are getting ahead. But McDonald's is saying very clearly, look, they're out of money. They can't even afford to come here and eat. And that is a big problem for the economy, as it means more jobs are soon to be lost. The burger chain has been offering discounts on its mobile app, but held off on a broader value campaign because it performed better than peers coming out of the pandemic. However, the results have weakened, with sales falling last quarter, and that's a big issue, despite the fact that they lowered prices. Because we talk about disinflation, we talk about the potential we're going to see the economy fall into outright deflation. Lower prices didn't work, and that's a problem, because what it means is that household budgets are strained in a major way. Because if this would have worked, then what McDonald's should have reported is we're seeing a flood of people coming in and buying the $5 meal deal, and over time it got better. They spent more money on other things that we sell, and we see the economy turning around. Instead, what McDonald's is telling us is that we're seeing the consumer get worse here. We're going to have to extend this deal because we're not even making more money when offering this. That's just an indication prices are still too high. Either that or consumer and household balances, our budgets are strained in a major way. At the end of July, McDonald's told franchisees that the company has recorded an incremental lift of nearly 3% in guest counts since the $5 meal deal began in late June. And this is something we're hearing from other retailers, that foot traffic is up, but spending is down. So what we're seeing here is consumers are coming in, they're looking for a deal. If they don't find it, they leave. If they find it, they're only buying what's on sale. This case, McDonald's, again, on higher foot traffic, lower prices, is seeing less sales. This is very dangerous for the company and really a broad indication for what's going on in the overall economy, which is telling us that these inverted yield curves and money curves that the central bankers did constricted the creation of credit and is now causing the economy to slow down and head into recession. But in any case, there's always opportunity, and why investors are chasing big tech higher. Well, we are only chasing a few trades here. Now, this is one case where less is more. When people think about trading, they think they got to trade every day. They got to trade all the time. We right now have 4 open trades on our CTA Time Pro. You want to trade against the machines and beat them? We show you how. Right now, 3 trades are up. That was a 75% win rate. We just added a trade today. It's up already. Our Momentum Time Pro, we trade against momentum like the RSI and the MACD, but we do it better. We've got 1 open trade and you think, is that it? I can make money with that? Look, it's not about quantity, it's about quality. When you trade with us, you make money. Why is that? Because we just finished the back test on our CTA Time Pro. It's now made available to subscribers. We show you the signals. We show you the probability that that trade will yield a positive return. We now have implemented that into our recommendations, made it available. Now you get the daily report, you get the tradable signals, you get the back test, you get my opinion on the best trades. I give you the stop loss levels. I even track all the trades and returns for you, and I update the stop loss levels each week. Here's the best part. Not only do you get a 30-day free trial, not only do you get the back test results for CTA, and yes, we're working on the ones for Momentum Timer Pro, but you get a system that is perfectly duplicatable. You can copy every single one of our trades. Links in the description below, because maybe this will be a way to turn around your finances in a big way. Because McDonald's is now looking to ban cash. This is not a good sign for the economy as they roll out kiosks that take cash, pushing diners away from cashiers. Now you think about what's going on here. I remember back when I was a kid, you'd go to McDonald's when they were busy and they would have multiple cashiers. There'd be multiple lines taking orders, getting food. But what's happened now? You walk in and there's really almost nobody standing at the course of the checkout. They want you to order on your app. They want you to order at the kiosk. Now they want to get rid of cash. And there's a good reason for this push, because as I'm about to show you, costs for producers are going up, which is backfeeding into costs for companies like McDonald's. But what did we just talk about? Consumers can't even afford a $5 meal deal. Foot traffic's up, revenue's down, when that means you have to cut expenses. The biggest one is labor, and this is something that's going to spread all across the economy. And while the bulk of McDonald's locations already have kiosks, right now most customers who don't pay with cards have to line up at the counter to finish their transactions with the help of an employee who's soon going to be out of work. Human workers aren't going away, but we can get by with fewer of them. That's going to be the goal. Because a new model, which is only in a handful of restaurants, would further reduce the restaurant's reliance on cashiers who can be redeployed to other tasks, such as bringing food to customers who request table service or curbside service, or perhaps doing away with them altogether. And that's the ultimate goal here. When your costs are rising, your revenues are falling, you have no choice but to cut expenses. That's where we're at now. The shift to digital is also remaking the nature of workers' jobs at McDonald's. Again, that's my point. The cornerstone of the U.S. labor market, with over 2 million people at its franchise restaurants around the world. And this is going to happen, not just at fast food restaurants, but we're going to see this proliferate all across different businesses who are going to look for any way to cut expenses, to cut staff, to automate processes, to do away with something as simple as saying, we just don't want to take cash anymore. And if we do, you got to put it in this machine. Well, I wouldn't be surprised if at some point you put cash in instead of getting cash out. McDonald's just issues a gift card to make it even easier. We'll see where this goes, because while workers may be spending less time taking orders and ringing people up, some are taking on new tasks like bringing food to customers who ordered online. Some franchisees have also started appointing guest experience leads to help customers, similar to how retailers like Walmart and Target station employees near self-checkouts, again, for all good reasons, to train customers how to use the kiosk, how to put cash in, so eventually that job will get lost too. You'll walk into McDonald's, there will virtually be nobody there. You'll punch your buttons, put your cash in, swipe your card, and then food will just show up. They'll call you by your number. We know where this is going. Fewer employees is what the game is here, and has everything to do with the fact that the economy suffered from high inflation and a lack of economic growth to support it. Now we're facing the reality of why stagflation leads to more job losses, because as costs go up and spending goes down, well, again, you put more people on the unemployment line, and we have more evidence now that costs for manufacturers and producers are going higher, and it's going to get passed on. U.S. producer prices pick up slightly after downward revisions as a PPI rose 0.2% in August. That's led by services. You want to see why the services sector is following the manufacturing sector to the downside? It's because prices are going up there. And again, if people can't afford $5 meal deal at McDonald's, what does it mean for the services sector? Well, it means a lot of pain is coming. The producer price index for final demand increased 0.2% from a month earlier, following a flat reading in July. The median forecast only called for a 0.1% gain, and compared with a year ago, the PPI rose 1.7%, the least since early 2024. Now, the good news here, and I'm going to show you a chart in a moment, is where final demand goes, the CPI, the Consumer Price Index, tends to follow. So this is good news on one front. The inflation is indeed coming down. There's this evidence the Fed will need next week to cut rates. I think they're going to cut twice instead of once. We'll find out for sure, but what this ultimately means is demand is coming down, and that is a problem because a measure of producer prices, excluding volatile food and energy categories, climbed 0.3% in August from the prior month and 2.4% from a year ago. So now we're seeing prices go up. We're seeing demand go down. This is an issue that's going to get passed on to U.S. consumers, who ultimately are going to reject it. In fact, that's what McDonald's is saying. We lowered our prices and they don't want to buy. Now, the problem for manufacturers and producers is the fact that they're seeing new order demand go down. They're seeing their backlogs get worked through, and even worse, they're building inventory. They, at some point, are going to have to lay off. It's not happening just yet, but there's going to happen here in the near-term future. And this is the issue we see with the PPI, is the producer price index in red went higher, but what happened is consumers rejected the higher prices. This is something that manufacturers and producers didn't want to see. The bigger issue here is minus food and energy. We see an increase in what's called the core PPI. This is dangerous because final demand, this is really important because this does pass on to consumers. This was unchanged for August after rising 0.6% in July. Now, why would it be unchanged? It's because what we're seeing is the final demand for goods is declining. So they're unable to pass on these higher prices. Again, you come back to McDonald's. Why is this a warning for the broad U.S. economy? It's pretty simple. You can't afford $5. Well, what does it mean you can't afford? That means the economy is not working for many Americans, not only the low income, but even the middle class. This is bad news. Because here we can see why the consumer price index is headed down. You'll note the PPI for final demand here shown in red went higher, and we warned about this because it didn't push the consumer price index up. And what happened is retailers and wholesalers had to absorb the higher price because there wasn't demand for consumers. We said ultimately this would roll over as we noticed that new order books fell, as we see backlogs go away and inventories rise. And sure enough, now we're seeing it start to roll over. This is dangerous because what it means is consumer prices are coming down. We know when that happens, of course, it means hours worked are going to decline, more Americans are going to hit the unemployment line. Then those are not signs we want to see, because it also means that the hope to get further wage increases, well, that's going away. Well, at least not for those who are about going to keep their job. And U.S. jobless claims pick up for the first time in 3 weeks. This is something we believe in the months to come is going to surge higher, as initial claims increased by 2,000 to 230,000 in the week ending September 7th. Continuing claims, this is one we really care about. A proxy for the number of people receiving benefits also rose to 1.85 million. So by and large, according to government data, those who are going on unemployment are virtually being offset by those coming off unemployment. But the problem is that continued claims number isn't going down. Now, in a soft landing or even a no landing scenario, even if it was delayed, as the Fed may tell us, we should see people coming off continued claims as job opportunities start to show up. We're not seeing that at all. And despite the latest increase, the level of claims has remained subdued for several weeks, which is baffling, even people like me. Economists have been on the lookout for any sign of downturn in the labor market, but so far there's been no such warning in the weekly applications for benefits. That is true. And again, why we're going to see the Fed cut rates, but perhaps they're going to talk about how you just need a couple of cuts. But by November and December, I expect that number from the continued claims to continue to head higher. It'll be full panic mode from the Fed. And there's a good reason why, because where continued claims go in blue, initial claims follow. So far, they're not. But at some point, they're going to head higher as we see people get stuck on unemployment, not spend in the economy. And next thing you know, that causes other people to lose their jobs and central bankers to panic. In fact, the ECB now first up, cutting rates again as inflation fades and the economy stumbles. On this, of course, we know they're doing it because the Fed pretty much said we're going to cut rates. This is opening the door for other central bankers to lead the Fed on the move down in rates, and they shall remain data dependent. Well, that is until the data says they got it completely wrong. And this is particularly justified in the view of uncertainty that abounds, and there's going to be more of that, a whole lot more. A declining path is not predetermined, neither in terms of sequence nor in terms of volumes. Well, that's because it never is, but yet we know they're going to cut rates because, like its global peers, the ECB is getting more confident that consumer price growth is returning to target following its historic spike. The Eurozone's 20-nation economy, meanwhile, is losing momentum as households are failing to support the rebound that began earlier in the year, and manufacturers remain in the doldrum due to soft demand from outside the single currency area, which is exactly what McDonald's is telling us. They're saying, look, consumers don't have money. They can't even afford the lower prices we offered them, and that is spilling out to the rest of the economy. That's the big issue here. As the recovery is facing some headwinds, well, it's facing a lot of them. The gradual fading effect of restricted monetary policy should support consumption and investments until it doesn't, because they don't realize cutting rates doesn't have any effect. On inflation, she said advances in wages will remain high and volatile, although overall growth in labor costs is moderating. That's happening because we see businesses do not have the margin to give out big pay raises. They're seeing their costs go up. They're seeing the spend and income go down from the consumers, and that is a problem. That means you can't pass on more wage growth. That means you're going to end up cutting hours, cutting jobs where you can, and this all points to the fact that the U.S. economy and the global economy are now heading into recession, and McDonald's being one of the first to raise the red flag and issue what we see as a dire warning for the global economy. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.